Get prepared for a market crash. That's the topic of today's episode. This is Todd Toback, and I want to welcome you to the No Limits Real Estate Investing podcast. If you're looking to get your first big paycheck in real estate, or if you're looking to build a business that spits off seven figures month after month after month, then this is the show for you. If you have not been to our website, head on over to nolimitsrealestateinvesting.com/script. And there you can get the very same script that my team uses up to lock up deals every single day. As a matter of fact, this script that you're going to get is responsible for locking up over 1,300 deals in our own real estate business. So go to nolimitsrealestateinvesting.com/script. So today, I'm real excited for today's show. We actually have a market expert, someone who has had an amazing YouTube. You got to go check him out, by the way, Reventure Consulting. I'll let Nick talk a little bit more about that. But I had a friend send me some of Nick's videos with some really, really compelling data that I thought our audience just absolutely has to hear. And so whether you think that the market's headed up or down or sideways, man, Nick's YouTube channel would really, really, really make you think and make you really, really, really get your ducks in a row for what he thinks that we are prepared for. So I had to have him on the show. So Nick, welcome.
Thank you, Todd. Really glad to be here.
So Nick, I know I stole maybe a little bit of your thunder, talk about what your opinion is about the market, but first tell us a little bit how you got involved in real estate.
Yeah, sure. So I run Reventure Consulting, which is a real estate data analytics firm. And as you said, I have a YouTube channel where I put out a lot of content, basically trying to answer the question, what are the cities in the housing markets that are overvalued and that are going to crash? What are the cities in the housing markets that are undervalued? And today in 2022, there's very few that are undervalued. There's a lot that are overvalued. And basically, I put data to this. A lot of people in real estate, they talk about markets, whether it's Phoenix or Tampa or Austin or Boston or New York, and they kind of speak in platitudes, and they don't really know the underlying data on what forms solid real estate values. And so what I do with Reventure Consulting is understand the cities that have the biggest risk of a crash, which I believe is going to happen over the next couple of years. But the upside to a crash is very clearly that if you're someone who's positioning yourself well, especially with cash, you should be able to pick up some discounts.
Well, first of all, I really, really appreciate that, right? Because I hate people who just talk about doom and gloom and there's no action point, right? They're like, okay, well, this is going to happen. How do I position myself a little bit? So we're going to talk a little bit towards the end of the show, but that's really what attracted me actually to Nick's channel, because one of our core values in our company is data, not drama, right? So a lot of people can have a lot of opinions about the market, but I'm watching, your videos and I'm like, this guy's got some, he's got some numbers to really back up what he's saying. And so that's what really, really attracted to me, what you're saying. I mean, I was just like, okay, now Nick has me listening. So Nick, tell me a little bit about kind of how you got involved in, creating the channel, right? I mean, what made you decide to create it and kind of what put you down this path lately of thinking the market is going to have this correction?
Yeah. It's a great question. Well, my path with Reventure Consulting is a combination of two things. The first is I've always been a data nerd. I was an economics major in college. Even back when I was a kid, I always loved reading like box scores for, baseball games and baseball players. I was always a statistics guy. And then after college, I worked for a real estate fund out of Boston for 8 years as an underwriter there, doing 10, 20, $30 million commercial real estate deals. Mm-hmm. And eventually kind of those two worlds started merging a bit. And I said to myself, I don't want to just do real estate deals. I want to understand why certain cities grow, why certain housing markets are more expensive than others. And I want to see if I can actually predict which cities and which markets are going to grow the most or crash the most in the future. So it was kind of this combination of my nerd economic data side with my experience on the institutional real estate side that led me to this. And I formed Reventure Consulting and started the YouTube channel in the middle to the end of 2020, which of course was very interesting time as the housing market was just starting to boom in that pandemic world. And then it was around the spring of 2021 into the summer where I really started issuing some warnings on my channel, using some data, saying, guys, hold on here. Inventory's at a record low. Home prices are trending to a record high. And when I look at the fundamental data, because what it comes down to, if you're investing in real estate, right, it's like job growth, population growth, inbound migration. How do those things compare to how many homes and apartments are being built? And how do the prices and rents compare to how much money people are making? These are really the fundamental things. When someone talks about like investing in a growth market, you got to analyze those data points. And all those data points start saying to me, wait a minute, the market is out of balance right now. It's in a bubble. And so that kind of started in the spring and summer of 2021. And then, now we're seeing in the first and second quarter of 2022 that the bubble is starting to pop.
So I think it's pretty obvious from the intro to the show that you believe that we're headed here for some kind of correction. So I'll have you say this. What are kind of the top 3 to 5 indicators that lead you to believe that we're headed towards a correction? And then how much do you think this actually can be?
Yeah. I mean, the number one indicator that anyone investing in real estate should understand is the home price to inflation ratio, as well as the home price to income and wage ratio. Because historically, over 100 plus years of US housing market history, there's a very consistent relationship between home prices, inflation, and wages. They tend to move together. And then when we enter periods where home prices go above the growth rate in inflation and wages, that's the sign of a housing bubble. And interestingly, it's only happened twice in US history where home prices have vaulted way above the levels of what people can afford, given their wages and income, and the cost of other goods in the economy, given inflation. 2006 and today. Only 2 times in US history that it's happened like this. We all know what happened after 2006. And now the inflation and wage adjusted home values are even higher than they were, are even higher in 2022 than they were in 2006. So that's like the number one metric, if I had to pick one, that suggests to me that we're in a bubble.
So that's basically how much people are, the prices of houses basically compared to inflation. And then basically exactly where their wages are right now.
Exactly. And so, it's interesting. Someone's initial reaction might be, oh, well, inflation's gone up a lot over the last year. So maybe that supports where home prices are. But, the interesting thing is, yes, inflation has gone up a lot, but home prices and mortgage payments have gone up so much more over the last several years than inflation. And, we're getting to this point now where the housing market is sustained by the marginal first-time home buyer, right? That's who sustains the housing market. And they're purchasing at record lows right now. And they literally can't afford homes at the current prices. Like, it's not a question of, like they're choosing not to buy. When you look at what their wages are and where the mortgage payments have gone with this combination of higher prices and rates, they can't afford to buy. So the demand is just getting locked out of the market right now. And so when that happens, you lose your marginal incremental demand for housing, and that's going to increase inventory and push prices down. And basically, like, I think a lot of people in the real estate world maybe are like sometimes scared by this. Like, they think, oh, if the housing market has a correction or a crash, it's bad. But, I would, encourage people to look at it like this. If home prices don't come down, that just means that home sales are going to collapse. And the housing market is going to just enter this no man's land where there's very few transactions, and it's really not a good place to be. It's going to be hard to get a loan. So for the betterment of actually like society and the housing market in general, we need prices to come back down to the levels dictated by inflation and wages.
I want to comment on 2 things. The first thing, do you know who Bruce Norris is?
No.
So Bruce Norris, he's was really big on making predictions for the California market. In 2004, he started talking about his number one metric, which was affordability, right? Which actually sounds very, very much in correlation to some of the data that you're pulling. Basically, how many people can afford a single family house, right? And he says, right when it gets to around 17 or 18%, then you need to start worrying. That's like the point where the market's no longer going to support it. So what was interesting is he started saying this in 2004, and he's like, hey, we're at a peak, we're at a peak, we're at a peak. But then in 2004, it was interesting. The government introduced negative AM loans. I don't know if you know what those are, right? But those are where you could actually pay 0.25% interest rate, right, on a loan, and then it was negatively amortizing. So a lot more people could afford it, right? So that propped up the market for a couple more years. And so that's, from like 04 to 07, that's when the market went crazy.
Yeah,
and then
another 3 years.
Another 3 years, right? And it went totally nuts. But he was right initially, because we were there. If it wasn't for that government interference, right, it would have crashed, a lot sooner. And we went up crashing even harder because obviously those loans completely went away, right? I mean, the whole product never even came back.
Right. That's a great point. So it's almost as if like if you go back to 04, 05, we were in a bubble, but it wasn't a horrible bubble yet at that point. But then you tacked on another 2 years of appreciation in 06 and 07, and that just became the cataclysmic housing crash.
Right.
So I guess are you getting to maybe asking or considering like, are we going to see something like that happen in 2022, in 2023, where the government comes in and tries to like sustain this?
Well, for me, that's part of the reason why I wanted to have you on the show, because maybe that's already happened, right? With all the money and the stimulus that's gone into the economy. What I've seen is like, okay, so you have a ton of people who weren't paying student loan payments. You had a lot of people who weren't paying mortgage payments. Obviously, you had all the stimulus payments that went out. You had a lot of people collecting unemployment and also working, right? And illegally. And so you had a lot of money being put into the market. So now is this domino effect, right, going to happen where that's no longer there? I mean, I don't know in terms of, I have no opinion of what the government's going to do. This is, definitely is not my expertise, but that's, a concern of mine, right? And I'm thinking, okay, is there going to be one leg that's pulled out underneath the chair, right? Is that we no longer have the stimulus? If I look at charts, go ahead.
No, I was just saying it's a very interesting analogy to call, to relate the easy lending of 0405 to the stimulus, because it's not exactly the same thing, but you get to a similar place. And I think you might be right in that all the money that was helicoptered into the economy, plus the low interest rate environment, plus just like the secular shift during the pandemic, right?
Mm-hmm.
There was objectively an increase in demand for single family homes, moving to the suburbs, more space, right? So like you combine all those things. But the interesting question I think you're getting to is like, were those just transient factors, and then you take away the stimulus, you take away the pandemic, and then what are you left with, right? You could be left with a market that's going to return to its 2019 values. And one thing, which would be a very big price correction, I mean, that would be a housing crash, right? That'd be a 25% decline in home prices. One interesting thing I've actually been looking at more lately, my expertise is on the US housing market, right? And all the micro locations and counties and metros. But I've started looking more internationally recently, because some interesting trends I've noticed is that America is not the only country right now going through the early stages of a housing downturn. If you go to Canada, if you go to Australia, if you go to New Zealand, if you go to Sweden, you go to all these countries, they're experiencing something very similar right now where home values are already declining. In fact, America's a little late getting to this point. And so that causes me to think that what we saw in the housing market the last 2 to 3 years was really just a result of the pandemic and low rates and stimulus. And now that that's normalizing everywhere at the same time, we're seeing a housing correction everywhere at the same time.
I had this one house in Tulsa, Oklahoma that I bought in 2004, and it was worth like $106,000 the day I bought it. And up until 2020, it was worth like $127,000. So if you do like the rate of appreciation from 2004 to 2020, you're looking at $20,000. I mean, you're looking at like less than 1%, right? I mean, it was
relative to inflation, you lost, right?
Relative to inflation, I lost, right, on that deal.
On appreciation.
Right? Well, now a comp just recently sold like 3 months ago for $200,000, right? And so I look at that curve there, and it's just unnatural, right? It's unnatural. We had every other, we've had a boom, right? We've had a bust, and I haven't seen anything like this in terms of the curve, right? So that's what's got me worried, and looking at your data a lot more. The one thing I would tell you also is we have a Florida market that we're in, and I can tell you that
which one?
It's in Treasure Coast, so it's the Indian River.
Is that near Palm Bay?
Yeah, so it's just south of, it's either south or north, but it's very, very close to Palm Bay, about 40 minutes north of Palm Bay, right?
Got it.
And I can tell you that what we do when we list our properties, we actually list them low, and we used to create this frenzy and then bid them up, use that excitement and the euphoria of the market,
right?
And that's completely gone. Right, it's completely gone. That we've already lost probably 5 to 10% of value. That I just see from anecdotally, right? Like if you pull the data, you don't see it yet, but just the excitement and the competition and what we're getting for properties, we're not getting them anymore. And so we're starting to see a slowdown already.
So I think I love the analogy you're giving. You're talking about Tulsa, right? And then you're talking about Palm Bay. like very different markets. And, this just to get into more nuance here, because I think your listeners and your viewers would appreciate this. I think more broadly, we're in a housing bubble in America, but you got to look locally, because I think there's certain cities that are like in massive bubbles, potentially bigger than they were in '07. I think there's other areas though that aren't in tremendous bubbles, and we'll see more of a moderate correction. And actually Tulsa is one of my favorite markets just from a data perspective, because while you're right, they've seen a tremendous increase in values in a short period of time. When you look at the long-term home price trend and you realize that potentially this market was slightly undervalued before the housing boom, I don't think a Tulsa, Oklahoma is going to get crushed, especially because you look at the wages. The typical value of a home in Tulsa is only 4 times what the average worker makes in a year in Tulsa. So even though it's gone up, it's still within striking distance. It's still within the realm of possibility for a local home buyer, even a young local home buyer in Tulsa, to afford it, which is important because that provides like a floor and support for prices.
Right.
When you get more like some of these markets in Florida, I get more concerned, because the local home buyers there, you can tell me if I'm wrong, I feel like they've been priced out now for a couple of years, and we're relying a lot on inbound migration in those markets to support the incremental home demand, which is that's great in a period of high inbound migration.
Right.
But historically, migration tends to be cyclical. So not only would some markets in Florida or a Phoenix or in Austin, Texas have to deal with higher mortgage rates, they're going to have to deal with, in my opinion, a slowdown in migration. That's just a secular slowdown that's going to occur over the next several years. And so, I think it's important to think about the type of market you're looking in. And generally speaking, I'm kind of advising people not to buy right now. But if you are going to buy, I feel like kind of the Midwest and the Deep South, these more slow and steady housing markets, like a Tulsa, are probably better places to go.
Right. What about that number where you're saying, okay, the wages to price? What is that ratio where you feel like, okay, you're getting in that dangerous zone?
Yeah, it's a great question. So more broadly, it's like, I think if you get above 6 to 1, like if the home value is more than 6 times the average worker wages. The thing is, though, some markets are so different, like LA or San Francisco is in double digits, and it's always in double digits. Right. It's like 13x. And so it's more like you got to look at your market and see what the incremental change has been over the last 3 years. So like if Tulsa, I think went from like 3.4 to 4.
Okay.
That's not like a huge increase. Austin went from 6 to 10.
Yeah, that's a lot.
So it's a lot, right? Or, so you got to look at your market specifically, because, these cities, even a city like Tulsa, it's small, but it's still pretty big. There's close to 1 million people in the metro area, right? Like things don't change that fast as far as the composition of who lives in a city. And so, that historical data on what that relationship of prices to wages is, and you can make your affordability calculation as well, something I do at Reventure Consulting. You take the home price, you take the mortgage payment, mortgage rate, and you take the wages, and you calculate how much a worker would need to spend on the mortgage payment. And when you see in a certain city that those just blow out of the water in 2 years to levels that are ridiculous, that's a sign that you should proceed with caution.
Right. So what is the second piece of data? I know we talked a little bit about that not affordability, but we talked about the price to earnings, and then we talked about obviously us being at an all-time high, even include, because there's a crazy chart on your either YouTube channel that I saw, which shows the graph that we are at the highest point of pricing, and that was inflation adjusted, right? So you can't count inflation in that. I mean, that was the one thing that really stuck out. I mean, by the way, I'd recommend everyone check that out on Reventure Consulting. But what would be the second piece of data behind all that?
Yeah, home building. So, there's some different narratives floating around about there being a housing shortage or there not being a housing shortage. But the one thing that's objectively true is that home builders are building actively under construction a record amount of homes and apartments in America right now. And you got to take a look at that home building for your metro and compare it to what the job and population growth is. Like, we got to get specific about this. It's not enough. I see so many like real estate investors who say to themselves, I'm going to go to Georgia, I'm going to go to South Carolina or Texas or Arizona or Florida, and I'm just going to buy there because people are moving there. But they don't attempt to quantify like, well, actually, how many people are moving there? How many jobs are being created? And what does that look like in relation to how many housing units are being permitted? Because the issue I'm seeing right now is, a market like Austin, Texas, permitted 50,000 new housing units over the last 12 months, double what it was like 4 or 5 years ago. And their migration actually trended down in 2021, and their job growth isn't even close to enough to account for all those housing units. And so what that means is like there's so much future growth being assumed in demographics to fill the housing construction pipeline. And that's like a risky proposition right now, right? We're entering a recession, rates are going up, home price affordability is at its worst. So if your market is now building a lot of homes relative to its organic growth levels, that's another risk factor that you need to consider.
Right.
Because then you just end up with oversupply.
I say this thing to some of my friends I talk about because everyone's like, oh, inventory is so low. And I'm like, well, inventory is so low until it's not, right? And so it's kind of, I think they call it I heard it in I think it was James Clear book, but it was called about latent potential, right? And so if you've got like a jackhammer, and you are hitting a rock, right? And you're hitting a rock and you're just hitting it and hitting it. It doesn't seem like anything is happening, right? And all of a sudden you hit it 50 times. Well, all of a sudden, like the 51st time, boom, right, the rock falls apart, or sometimes I'll see it like in the gym sometimes where you're working out, you don't really see anything. And then all of a sudden you look in the mirror like, oh, wait a minute, this is, really working.
I see some muscles.
Right, I see some muscles, right? So, I think that's like a lot of where, the inventory is really low, right? But then all of a sudden you have this building that's going on and these houses that, you're right, it's not getting soaked up because they're not done, right? And then you have these other factors going on like interest rates going up and now people aren't migrating. You have consumer confidence going down. Flippers now are getting more conservative because now they feel it, right? So they're not now going to create new product, which now is going to take like 3 to 6 months to actually hit the market because they're going to finish the stuff they have. Right. It seems like this is all going to kind of culminate all at once.
It's so fun. I love that analogy with the latent potential because this is like how a cycle works, right? Even like, the 80s and early 90s housing cycles, which weren't big busts, but like this is kind of how it works, right? Like we enter the tail end of an economic expansion, people are feeling wealthy, they buy homes, inventory goes down just as home builders are building all these homes, right? And then all of a sudden we have inflationary pressures and the Fed raises rates. And then, like you said, it all kind of comes to a head at once. And, inventory is an interesting statistic because clearly it's very important, right? It's a signal of what's going on in the housing market. But I like what you said, like you could point to the low inventory levels today in certain markets, but that doesn't tell you anything about what's going to happen in a year, especially when you think about some of the things that occurred during the pandemic. Like we had the foreclosure moratorium, which reduced foreclosures by 700,000 in 2020 and 21 compared to the 2018 and 2019 baseline. Wow. Foreclosures were down 700,000. I wasn't even accounting for the fact that defaults went way up. It was just down 700,000 compared to the previous 2 years. In addition, we have an eviction moratorium where we have 3 million fewer eviction filings. So is it possible that the combination of these factors could have artificially constrained housing inventory? Then you pile on investors buying into the market and all these things and people buying second homes. And there you go. Record low inventory. The question is, what is it going to be in 3 months, 6 months, and 12 months? And I think even if someone's not in a city like Phoenix right now, you got to be paying attention to what's going on in Phoenix. Because literally in 3 months, Phoenix now is above its mid 2020 inventory. Oh, wow. Like in 3 months, it's gone up by 400%. So to your point, inventory can just rocket up very, very fast when the market dynamics shift. And so, I personally am not really paying attention to like the prevailing inventory. I'm more looking at like, what's the incremental momentum and change? And then what are the risk factors? Because again, if you're in a market where the affordability is out of whack and people can't afford homes and there's a lot of home building, that's a cocktail that's going to lead to like perpetual inventory explosion. Right. If you're in a city or a metro that's still affordable for a local home buyer and is not building too many homes and apartments, you're probably going to see an inventory surge at some point, but it's going to be more muted. It's going to be more restrained and there won't be as big price declines.
Right. It's really interesting. 2007, I don't know if you were in real estate in 2007, but 2007 was, for me, one of the worst years in real estate. I mean, ever. I mean, I was making money, from 2000 to 2007, but you mentioned something earlier in this interview that I want to, talk about. And what happened is that we were like at that top of this roller coaster where nothing was happening, meaning that inventory was building, but sellers weren't lowering their price. Prices weren't falling yet. They were just kind of there, right? And it was just like nothing was happening. So when you talked about a market correction, it wasn't correcting enough for the buyers to rush back in the market, right? But then sellers hadn't capitulated yet and lowered their prices, right? And it was a very, very, very like it seemed like forever, right? Because just nothing was happening, right? It was like this, this weird.
And how long did that situation last for? Like, when did it kind of begin, and then when did it end? Like, and when did the capitulation finally
it was 2007. Like this is a long time ago, geez, but it seemed like it was a full year, right? So 2004, it seemed like that, some of these people were saying, okay, the crash is going to happen. Then it seemed 5 and 6, that's when those negative AMs came in. In California, it seemed like got it hit first. And then like in Florida, you see like, those areas kind of had some more room to run at the time, right? But as soon as those negative AMs kind of went away and they stopped lending, and that went away, it took a little bit. I don't know, but it seemed like forever because I was having a really hard time making money at that point. I mean, I didn't know then what I know now, right? But it was tough because I just sat there. You didn't want to buy anything, right? Because you were scared, but the sellers weren't willing to go to a price where you could buy at that point.
It's like a purgatory housing market.
Yes, purgatory.
And then what burst the dam? Was it, or maybe it was multiple things. Obviously there were foreclosures. Maybe the inventory just got up to a certain level where it became obvious. Or, I mean, was it the economic downturn that really just like burst the dam? Like what was it from like a pop in the bubble?
So I think, the lenders weren't really negotiating short sales. I think that was part of it, right? So you'd go in there and try to negotiate a short sale in 07 and they weren't even prepared for it, right? They didn't have like the staff and the people there to even know. And I think that was like the biggest part of it, is that the lenders just didn't even, if you asked 90 people in the organization what a short sale was, they probably wouldn't even know, right? at the bank at that time, right? So they had to staff up to actually make that happen, right? They build up their loss mitigation departments. And so that seemed like it took a while. And also the lenders willing to take a haircut, and then the negative amortization loans to actually fully go away. And then sellers, they have to actually capitulate, right? And say, okay, I thought my house was worth $1 million. Now it's worth 700. So I think it was a combination of things, right? The stock market crashing. I think one of the things I'd love your take on this, because I remember in 2006, I had met with a seller, and this guy was motivated. We were in this like flat portion, Nick, right? And you're gonna laugh at this. And anyway, this guy had this new gadget on his table, and I'm like, oh, what's that? And it looked a lot like this, right? But it was an iPhone 1. So Facebook, didn't exist, and I think everyone was kind of getting on MySpace, and so, back then we didn't have social media. This last crash, right, which did not spread the information and the fear or the anxiety, and so this emotional connection about what real estate is. Right. So right now, if you asked everyone a year ago, everyone's like, gotta get in real estate, gotta get in real estate, gotta get in real estate. Everyone knows that real estate's going up. I think maybe, I don't know, this is my opinion, and I'd like to hear your thoughts on it. How will social media and the emotional aspect take hold here, right, this next year, right? Do you think that this will happen faster because of social media this time around?
That's a great question. And I think we got to also link Zillow in with that, right? Because it feeds onto it. The fact that you can look up your home value every day, right? Almost like checking your stock portfolio. And then you add social media onto that. That's a really interesting question. I think it will, for a simple reason. Like if you look historically at bubbles, going back hundreds of years, whether it's a real estate bubble or a stock bubble or whatever it might be in different countries, these economists out of the UK, they found that there's like 3 consistent ingredients to a bubble. And one of them is what's called marketability, which is basically like the wider the net of people that get caught in it is, like the more like retail people, the more amateur people get caught in the net of the bubble, whether that be through buying and selling, whether that be through intrigue. the faster and harder the crash typically is.
Right.
And so I think for me, this is what it is. Social media on its own is one thing, but what that caused was that I think more people started buying and selling homes or starting thinking of themselves as a real estate investor. Like right now in America, investors own nearly 20 million single family homes. That's way more than it was 15 years ago. And so not only do you have social media kind of like feeding the frenzy up and down, we've now built, because of that, a larger and larger share in stock of ownership in the housing market among people who actually don't live in the house.
Right.
So that to me is like that combination of ingredients, I think, yes, could make it happen faster, could potentially make it deeper. There's different arguments you could say, like as soon as the downturn happens, then information gets disseminated and more people come back into the market. Could be an argument. But I think your point about speed is probably right. So, historically, a housing crash takes 5 years to play out from peak to trough, whether it was 2007 to 2012 or LA in the early 90s or Houston in the mid 80s. But maybe this is going to be more like 2 years or 3 years to get from peak to trough because of those reasons. I think that's a really interesting thing to think about.
So if you're listening to this, by the way, I have a lot of ways to protect yourself during this time. And, I'll continue to share those on the podcast. And again, I don't want to discourage you, right? Obviously, when you can make money in any single market, I think this is going to be a lot of opportunity. We're still making a lot of money right now. But Nick, let me ask you this. I'd love your opinion. And that is, how would you advise our listeners today, right? If you're making your money in real estate, right? Number one, how do you protect yourself? But two, how would you go about keeping your business going or making money right now?
Sure. I think the first thing to be is very clear about the longevity of your asset purchases, like how long are you holding for? You need to be very clear about that, because if you're buying for a 10-year hold right now, you could still probably do it and feel okay. If you're buying with this idea that I'm going to hold for 2 or 3 years or flip, or then you can run into issues, right? Because you could be walking into a down market. So understanding the longevity of your hold is really important. The other thing is really understanding your mental and financial fortitude for absorbing a value decline, right? So say you buy today because you like the cash flow on a specific investment property. Well, go into it thinking and understanding that the value is going to go down by 20%. Like you need to just like prepare yourself mentally for that. And I think for some people, they're okay, because if you do that and you get cash flow and you hold for 5+ years, it's not a huge deal. The values will eventually go back up. But I think having that mental clarity that we are entering a housing downturn, that doesn't mean you shouldn't buy at all, but just understand what you're walking into. That's probably the most important thing I would advise people on. Number two, also just understand your market, right? Like if you're buying into a market, like if you're a cash flow driven investor and you're buying into a market at a 4% cap rate right now, or a 3.5%, like that's probably not a great decision, right? In a rising interest rate environment, entering a recession. Right. But if you're in one of these Midwest markets, or I bet you, probably the yields in Tulsa are pretty good. You're getting 7% or 6.5%. Like you could swing that, right? Because you're going to be getting a return that's a good return compared to other debt instruments, and you're going to have some cash flow. So I think really looking at that cash flow yield is super important, and you're targeting those higher yield markets and investments right now.
So a lot of our audience, they're in and out of the real estate, right? But I mean, obviously, if you're flipping, but if you're flipping, in this, you can really get caught, right? And especially right now. So in San Diego, you've got people who are buying 85% of ARV, 86% of ARV minus repairs. So ARV stands for after repair value, right? And so they'll buy like a house that's worth 800 and they'll buy it for like 670 and it needs like, 40 grand in repairs. And they think that's okay, right? They've been doing that. And actually the interesting thing is that they've been crushing it, absolutely crushing it, because the market's been going up, right? And you haven't been doing that. But now you get in a spot where all of a sudden now you lose 10% and you're holding 10 properties and you're going to get absolutely creamed on something like that.
Yeah. That's a really interesting thing to think about. If you're flipping, your risk factors are much higher, right? Because you're really tied to home sales and appreciation.
Right.
And the no man's land for a flipper, like could be just as bad as, like the stages of value declines, because like if home sales just tank, and you say values don't crash. Like if home sales tank, right, you're just set, you're left holding the property. I mean, look, I think one thing I'm doing is looking at an open door, just as like a signal of what maybe Wall Street is thinking about home flipping right now.
Right.
And, it's clearly not good. And I'm seeing open doors start to struggle a lot. And clearly they don't have a great business model, right? They're trying to nationally scale flipping. They don't do renovations or whatnot. But I think that's a signal for what you could expect as a flipper. And, I don't know. I would say try to be flexible. Like understand that if you do want to flip in today's market, you are taking risk, and get ready potentially to rent out some of those properties. Yeah. Right. Like get ready to rent out some of those properties.
It's interesting. So one of the things that we'll do, I'll share, is that if we've got a property that we don't want to buy right now, but we know we can stick back on the market, we'll put it under purchase contract. But in our contracts, we have the right to clean it out, right, and paint it and recarpet it, and then remarket it before we even close, right? So we can actually do all that, not actually have the purchase price as a as a liability, basically, right? And the only thing our only liability is basically the cleanup and the repairs. And obviously the risk is that if it doesn't sell at the price we thought, we're just out that, right? But we're taking almost we're getting the benefits without the risk. It's forced us to get a little bit more creative in this market.
So is that like almost like an option?
Exactly like an option.
All right.
Yeah. Exactly.
Yeah. I mean, I think that's really smart.
Yeah.
You're definitely mitigating your risk there.
Yeah.
And maybe there'll be more sellers who are willing to do that, right? Like as the housing market gets tighter. Let me ask you a question. So like when you say flipping, and most of your listeners do flipping, is it like value add flipping, or is it kind of just like speculative trying to flip the house for a profit with minimal repairs? Like what's the main?
Yeah. So what basically if you look at what Open Door does, right, I feel like we do it, but in a much, if their market would continue to work, obviously they would be smarter. But in this, what we do is we actually go and we're buying at substantial discounts from sellers. So we do a lot of direct marketing. We spend a lot of money on postcards and SEO and Facebook advertising and outbound texting. And so we'll go and we'll buy that property 60 or 70 cents on the dollar, right? With the seller, we'll go under contract. And typically we do little to no work. So sometimes we'll just wholesale it, we'll just sell the contract. Or if it's a big juicy deal, we'll buy it, right? And sometimes it has some kind of defect in it where there's a tenant in it, or just filled with stuff. And so those we like to buy, clean them out, get rid of that defect, and then sell on the market. And so that's about 30 to 40%. The other 60, we just sell the contracts. But we've gotten a lot more conservative because this last 2 months, like we've had deals that we thought that we were going to make a lot more on. But because of the market, I mean, we probably lost out on 200 grand in profits on deals that we thought we didn't lose money. But I mean, it's the same thing almost sometimes when you're almost counting the money and you're like, I thought I was going to make.
You build the expectation.
Yeah.
You build the expectation. Well, I mean, that's interesting. Look, I mean, if you're getting an off-market deal truly at a 30% discount, you're mitigating your risk in a big way.
Yeah.
Right. So I guess to the extent that you can honestly say to yourself, you're getting a deal at a 30% discount, potentially that's still a workable business model. I guess the question I have is like, how many, like, especially new people have gotten into this who potentially are going to stretch. Right. Like, and are going to say, okay, like this is now my career. I need to keep my, my labor employed. Like I need to keep the lights on. Yeah. So I got to keep buying and selling. Right. And so, it's probably good to be nimble right now, not have too much overhead, be able to scale yourself down when you need to scale down, and then scale up when the buying opportunities really come.
Right. Well, Nick, I mean, that's a really, really good point. I think when you say stretch, first of all, I think a lot of people get into this business too, and they want to do a deal, right? So they start massaging the numbers, right? And they're just like, this is a 30% discount. No, it's not. Right. So yeah. I think you have to be honest with yourself, really look at data, right? You seem like you'd be really good at not stretching the numbers, like, hey, this is, this is what it is.
Well, like as we're speaking, like I'm just kind of thinking in my head, right? Like you could look at it metro by metro, but then I would think also looking at things zip code by zip code,
right?
Because, already we're seeing big shifts in like the areas where inventory is surging the most. So like right now in America, it's the suburbs and the rural areas where inventory is exploding.
Right.
Like all the places that boomed in 2020 and 2021 the inventory is just going nuts. And part of me is thinking that that's not just mortgage rates. That's like secular trend. We pulled forward home buyers during the pandemic.
Right.
Who are going to move to the suburbs. Now we don't have as many. So maybe it's like those areas, like you proceed with major caution, right? But interestingly, in urban areas and a lot of places, inventory is still down year over year.
Right.
Potentially because there's like a secular shift back to more urban areas. And so I think there's ways to use data and get really granular. And I think it's really important to have a strategy, right? Like I always think about where are the demographics going? Where's the most affordability, right? And if you think about creating your strategy around that, like where is there still affordability? Where are the demographic trends shifting? Not looking in the rearview mirror and just blindly repeating people are moving to the Sun Belt and they're going to go to the suburbs. That's not, that's starting to change.
Right.
And so really coming up with like a data-driven strategy, for your home flipping or whether it's cash flow as well.
One of the things you really said, by the way, is I'm not sure if you called it, but it's kind of like the herd. Everyone's saying like, oh, everyone's moving to Florida, right? One of the things, and I know we're getting a little bit zigzagging a little bit here, but one of my concerns about Florida sometimes, I'm like, I don't really see some of the jobs, in some of these areas, right? Like it's not like, I mean, outside like maybe Miami or Fort Lauderdale, like that area I was talking about, right? I'm like, actually, there's hardly any jobs right over here. And I'm like, maybe people are moving here, but eventually these people are going to have to work, and especially people getting called back into the office. It'd be really, really, really interesting. Nick, this has been awesome. I think one of the things I've gotten is that there's some really, really great data. I think people have to check out your YouTube channel, Reventure Consulting. They're awesome. They've got a lot of data, highly entertaining, by the way. Great production value. So thank you for putting that out. I know as a content creator,
I appreciate that,
I don't take that lightly. So please go there, subscribe to Nick's channel. One of my biggest thing now is go out there and take some action, right? I think I would know where the markets are, where I want to be. I wouldn't take too much risk at this point. If you can do a deal and get a giant discount and price that in, right? Go ahead and do the deal if you can price in what we believe to be a pretty significant crash. But then the last part, I'd love to hear and end with this. How would you prepare and set yourself up? I mean, this is like, this is where the all the meat of this episode is, right? Because I think if you're right, this could be the best buying opportunity of our lifetime. How would you prepare, and how are you preparing?
Yeah, it's a great question. So, I mean, the first thing is making sure your cash position is growing, which can be difficult for some people in this inflationary environment, and values going down across the stock market. But really fortifying your cash position, because I truly believe. And actually, let me just ask you a question. On most flips, is it a cash transaction already, or is it finance?
It's a cash transaction, but a lot of times, again, they flip paper, right? Which is a lot of fun. But also, you can go get a hard money loan. Do you know what a hard money loan is?
Yeah. I used to work for a high yield bridge lender.
Okay, yeah. So in the residential, they call it hard money lending. So a lot of people get hard money loans or private money.
Got it. Well, I think the capital is going to dry up. I'm already hearing it's drying up in a lot of those industries. So I think, look, fortify your cash position, because I do agree there's going to be buying opportunities, but you're going to need cash to be able to do it. If you're flipping a contract, I guess you don't, but if you're taking a title, you will. And so fortify your cash position, but then start thinking about the cities that are going to have the biggest housing crash. Because undoubtedly there are certain cities that are heading for a huge decline.
Right.
And these are the areas that were like the bells of the ball the last 3 or 4 years: the Phoenix, the Boise, the Austin, the Salt Lake City, the Tampa, the Atlanta. These places are going down over the next 2 to 3 years. And so these are the areas where, like, today it's scary to buy, but in a couple of years, there's going to be major buying opportunities in these locations. And the thing to prepare for is that the narrative will have flipped. The herd narrative will have flipped. And in 2 years, people would say, you would be nuts to buy in Austin, Texas. You would be nuts to buy in Phoenix, is what people are going to say in 2 years. And that's when you're going to take your cash position and buy in those locations at a discount and make money. So that's how I'm thinking about it.
That's killer. I'll add to that, by the way. If, there's some people on here who can't even imagine like hoarding enough cash from their job, right? But I would tell you that there are so many people out there with cash, right, that you could partner with. Right. So I would add line up partners, right, who do have the cash. I remember at one point I was coming out of 2007 and I had partnered with people and we bought rentals and we used all our cash and partner and I was able to build up a portfolio and start up that way, which was just awesome. But
that's a great idea.
I
guess that's a great idea. You just got to offer value to them,
yes,
right? So you got to come to them with like a strategy and connections and know-how that add value to them. But I think that's a great idea.
And also energy, right? A lot of times you'll get people in their 50s or 60s who want to invest. They're not that quite retirement age and they're not going to go, hunt down these deals or read the data or they just don't have a desire to. And I think, being with a partner is huge. But again, check out Nick's YouTube channel, Reventure Consulting. Do you have a website that you want to give out, Nick?
Yeah, it's www.reventureconsulting.com. But the best way to get in contact with me and to follow my content is on YouTube, like you said. So follow me on YouTube, subscribe, Reventure Consulting YouTube channel. I do 3 videos a week on the housing market and the broader economy.
Awesome. Thank you so much, Nick. Remember, if you want to get that script, head to nolimitsrealestateinvesting.com/script. And man, get ready to use that thing and make some money. Talk to you soon.